What's up, party people? My name is Sunny Ray, and this is the Sunny Ray Show. My next guest today, his name is Charles Solomon. He's the founder and managing partner of Centripetal Advisors. I'm going to bring him on stage. Charles, where are you calling in from today?
Actually, today I am in Averill Park, New York.
Cool.
Upstate New York, a little bit of a break. Usually I'm down in Jersey, right outside of New York City. But this week we're taking a little bit easy before school starts for the kiddos.
Awesome. I actually took my little kiddos to New York last week, and it was epic to say the least. Hey, I was gonna say your Twitter thing didn't quite connect. That's okay. We'll figure it out maybe on the next episode. But do you want to take
Okay.
us into the deep end? It's okay. We'll figure it out later. Do you want to take us in the deep end? What is Centripetal Advisors? A fractional CFO firm. I guess you launched in 2018. Can you tell us a little bit more about it? Like, what's the kind of the problem that you guys are solving in the marketplace?
Yeah, absolutely. So, take you back to 2018, right? In 2018, I helped a company raise $60 million, and it wasn't my job. I was in a different business development role, but I had the network and some chops and was able to do that. And that founder introduced me to another founder and another, and they kind of had all the same financial setup. They all like, hey, I want to raise money. And I'd ask, well, what are you doing for finance now? And where are you at? And they're like, it wasn't so organized. And okay, what's your plan for the round? I don't really have structure to our process. And okay, so after you raise, how are you going to handle all things finance with an institutional partner? Oh, we'll figure it out then. So, and a lot of them, they might have a bookkeeper or something basic, right? Help you kind of understand a little bit of past performance. But they're all passing on like a full-time hire back then, maybe like all in 200K all in. I'd say a good full-time hire, certainly more expensive now. And there's nothing in between. And so I started Centripetal to offer to fill that gap, right? Fractional finance, part-time financial leadership for a company that doesn't need a full-time hire, but certainly needs something because nothing wasn't cutting it. And then founders would wind up in really difficult situations under a lot of stress and potentially risking economics and control in their baby, which was horrible to watch. So, today we're an AI-powered institutional quality finance function for B2B tech companies that are scaling. And what that looks like is, fractional financial support with a lot of AI learnings and automations that make that part-time person quite efficient and powerful. And we're obviously continuing to go in that direction.
That's super interesting. You said that working off burn to get to break even likely costs you your growth rate, right? So can you make that argument properly as if I'm the founder about to do it?
Yeah, listen, if you're in a really difficult spot and you need to get to break even to survive because there's no money coming and otherwise your company may die, then go by all means get to break even. But generally speaking, right, you have to invest to grow your business. And a good rule of thumb is if you don't make any investments in improving the product, improving go-to-market, whatever, and you're kind of steady state, and this is for slightly more mature companies, you can expect your growth rate to decrease by 85% year over year. Your growth is going to come in. Doing more of the same might net you more of the same, but because you'll have more revenue every year as you do grow, it's like your growth rate will come in. So if you have $4 million in revenue and your sales team can produce 4 million, well, you grow 100%. That's great. Congrats. Next year you got 8 million. You make no investments. Let's say you produce another 4 million again, run the same play. Well, now your growth rate's 50%. So in order to keep growth up, and growth is the number one driver of valuation, assuming retention is healthy, and retention can play a very big role. You will have to invest across the organization, but certainly in R&D and sales and marketing for up and coming technology companies so that you can sell at a volume that maintains the growth rate. And when you choose not to do that, or to even, forget like not investing, when you choose to cut the current spend, you're asking like your business to defy physics. Like, hey, we're going to grow even faster, but with less people, less resources. And as a CFO, I'm very sensitive to waste in companies, and there is waste in companies change and people are no longer a fit, and people change and they're no longer fit for the same company. So like there's, churn isn't like a terrible thing. It can make sense for everybody. It can be a healthy thing. But if you are not investing in adding capacity and skills and channels and volume and features, it's very hard to keep a growth rate up just based on the numbers. So that's really the thinking there. If you're growing and you're burning, you're not growing that fast, your retention's bad, no one wants to invest, then yeah, you might want to get to break even to survive and try to live another day. It's always better to live longer, but if you're thinking, hey, I'm going to cut costs 25%, and then my growth rate will also go up because, things will be better. That is a very hard thing to do and highly unlikely. It's a very, very bad base case plan. And it's probably even an unfair, like aggressive case plan.
Interesting. So when is getting to break even genuinely the right call? Like, how do you tell the two situations apart from inside the company?
Oh, it's a good question. There's no like perfect answer. Well, one is obviously, hey, look, we're uninvestable for whatever reason, you name it, customer concentration, whatever, and we want to live, and no one's going to put money in, and we've got 4 months of runway, or 3 months of runway. So even if we're in a process, we're like way up against it, because the investors have all the leverage. They know you're about to run out of money. Getting to break even provides optionality for the business, and that's a great thing to do because you can live more than 3 months. It's better to survive longer and find more opportunities to grow. So certainly when you're up against it, getting to break even is great. I would say for companies that are like Series B, Series C, break even can be a valuable milestone. Investors say, hey, if I invest in this business, I don't have to put that much primary capital to work. It's already efficient. Whatever the business does to grow, it can invest back in the business because it's not burning. You can also, if you get to break even at certain points, like as a product becomes mature or a business line becomes mature, it's a nice thing to do before you say, hey, you know, let's get to break even and let's talk about what we need to invest in to get to a new market, to build a new product, to get to a new space. And then that can be a new investment case where you're deploying more money in, but hey, the core business is profitable. And I think for companies, especially that are growing like, 40 to 80%, it can be a real reasonable target for them. Um, because also you have to think about like metrics that financial investors, and even strategics value the business on. You think about like rule of 40, right? You're growing 40%. If you're burning 20%, then you're a rule of 20, and that's not so attractive. But if you're growing 40% and you're break even, now you're rule of 40. Business is inherently more valuable. One time to game this and to maybe invest and benefit in the short term, even if you risk the long term, is prior to a fundraiser or transaction, because you're making your financial metrics as attractive as possible, and you can game it a little bit to get a better deal. Especially if it's some type of sale where you're really taking a lot of liquidity and maybe not as worried about future outcome. I don't know how many funds would want that to be said, but I think that's true. But I think if you're a fast growing company, like OpenAI doesn't need to get to break even. Um, you know, those companies. If you're a really fast growing company, you're in the business of growing really fast, and growth is what even for public companies gets valued the most. So if you've got avenues to grow, levers to pull to grow, and it requires some investment, by all means. If you're growing a little bit more slowly and you need to tell a more efficient story, maybe your market isn't as big, right? So it doesn't make sense to try to grow as quickly. Then break even can be a really nice milestone for investors, and also for the company. Hey, break even, you can run the business however you want. You can leverage debt to grow instead of equity capital. You can choose to take no more money. And that's always a great thing to say to investors. And I'd say another time I see break even make sense, and this is for earlier stage companies, but there are cases you want to bootstrap, you better stay close to break even, because otherwise it's gonna, your money's you're gonna have to spend your money to keep the company going. So you want to try and bootstrap a business, you got to keep that burn down and manage around that however possible.
Can you walk me through the moment like a founder decides to cut to reach break even? Like, well, what actually happens over the next 6, 12, 18 months?
Well, I mean, there are different moments. like I said, you could look at a business with 12 months of runway, 14 months of runway, say, hey, we want to do Series A in 6, 8 months, whatever. And this is what we need to do in terms of logos and growth and revenue mix and all that stuff. And then, over time, you're watching all the numbers and you haven't quite gotten there at 9 months, you haven't quite gotten there at 6 months. And then it's 4 months or something. And you might say, or even at 6 months, you might say, we're really not going to get there. We're limited for whatever reasons, and we haven't quite figured this out. If we don't make changes today, then we're just going to run out of cash and then we're dead. So at that point, you kind of pull the ripcord and say, all right, how do I make the cuts I need to make so I can get the business to break even? And you got to do it in advance too, because even if you're cheap about it, there's going to be severance. You're going to need to be able to consolidate roles. You're going to need to figure out who's actually doing what's needed, how you can push that onto the current team. You may make some cuts. Some people may say, hey, I'm really busy. You may have to now that there's less people around, you may have to find ways to incentivize them. Hey, we're going to give you extra options, or yeah, we made some cuts, but we're going to have to give some folks like small raises because they're doing more work, things like that. So you want to start early and have all that stuff work out and be really thoughtful about it. So the business can run at break even if it's a smaller business. So I think that's obviously the most critical one is we need this to survive. I don't think businesses that are maturing and growing, like I said, that 40 to 80% range, that think about rule of 40, I don't think they're ever going to totally game it to get to break even. They're going to kind of think about what the long term is. They got stuff in front of them. They're excited, but I do think, as they approach financings, they could be thinking about, all right, have we done a sufficient performance review where maybe it surfaces that some people or one person or two people really aren't performing at all or have no longer become a fit because the organization has changed. And can we try to address that in different ways? So it's a win-win. Like, hey, if someone's not a fit, they're not happy at work. That's not good for them, right? So maybe you find some ways there, or you're doing like a vendor sweep and you're just constantly going through all your vendors and everything that they're providing. And you just kind of trim down as opposed to like a big cut to break even. Because if you're growing, you want to keep growing. There are a lot of risks to making those cuts, like to survive. Like I said, if you don't have the right customer success support, you risk retention, you risk losing customers, and then all of a sudden you have to cut more because your revenue base is less, right? You risk a competitor building functionality and getting ahead of you, and then all of a sudden no one wants to buy your product, right? So you do want to be able to spend and invest in the business, but if you got to survive, you got to survive. And I think as you get closer to if you feel a lot of pressure from investors or you really want optionality, you can kind of scan through the organization and make sure you're getting like optimal ROI on everywhere you're spending. And then if you decide that you're not, and there are places where you can remove spend from, which is never easy, then that can help you get to break even.
Yeah, that's super interesting, man. So I was gonna say, you've been on the buy side at ADP, right? In a kind of in a portfolio role.
I was in a business development role there, so I was building partnerships with private equity and venture capital, but we
Got
weren't.
it.
We weren't deploying.
Right, but I guess now you're on the kind of in the advisory side, right? So what does each seat let you see, I guess, that the others kind of like do not?
Yeah, let's first of all, yes, I'm on the advisory side, and that's what we do. I would also say that to a small degree, I'm on the buy side as well. I've written angel checks into clients, and some are a little bit bigger than 5K, right? Some are pretty serious stakes, at least for me. I wouldn't say in the grand scheme, but at least for me. So I definitely wear an investor hat in my own head as I look at the clients too, where we've invested. So I think that's worth pointing out. But the advisory side, I think, especially in our role, is ultimately seeing the companies through the founder's eyes. That's really the trick here, is seeing the business as the founder sees it, and then seeing the business as all the numbers and the data you can get your hands on see it, and trying to point out where there's alignment and where there are discrepancies and what that means for decision making. And I think, especially in our bigger engagements with our bigger clients, we're also working towards seeing the business how the department heads see it, like the senior leaders, the 2 or 3 major players at the company, and again aligning them with data. Here's how you're seeing it. Here's what you're thinking. Here's what the data is saying. And so everyone can be as objective and honest as possible about what's going on in the business and ask the right questions and push on the right issues and prioritize the right items. That's really the game, is founder alignment for us. On the buy side, I think you'd like to think that that's the case too. I think generally it is, but they have different incentives, right? Like a founder could fire us and then the engagement's over, and that's the ultimate hammer, right? So, but on the buy side, like they want to raise another fund. They have LPs that they have to make money for. They've got metrics they've got to hit, and they're kind of thinking about those things too. They want to win the next deal also. So how to stay attractive in the market, have a good reputation, but really you want to have more funds and more success. And so those are the things that they're thinking about. And a lot of that comes from having a founder perform really well. Like that's where the alignment is. The founder and the management team performs well, and they get what they want. But I think there are moments where their incentives conflict a little bit with what's best for the company, which is natural. And everybody kind of has to be open about how they're thinking about things and work through it. And good investors are able to kind of speak through these things. And a lot of founders, especially first-time founders, need to be taught, hey, this is the investor perspective. This is your perspective. This is why it's different. It's not that someone's good or bad. It's a bit of an alignment thing, but this is how we can find a common path that everybody can understand makes sense. So sometimes we play that role too of kind of translator there.
So you guys work only with like essentially B2B companies, right? And only really with Series A founders. Why narrow it that hard when kind of the category rewards taking anyone?
Well, I don't agree with that statement. I don't think the category rewards taking anyone. And we do work with more than Series A founders. I mean, we work with Series B founders. We work with Series Seed founders. I've worked with pre-seed founders on a coaching basis. But you want to work with folks that have some form of product market fit or institutional capital behind them, because in both instances, having finance in place either helps them with investor relations and managing kind of the institutional side of things. And usually they do have PMF, but if they're pivoting or they don't temporarily, then that's a good place for us to still help them plan and think and grow. But usually the folks with PMF, they've got revenue, they have retention metrics, they have KPIs that they can manage and measure and will be judged by. And they need to be on top of all of those things and either think about how that impacts their ability to procure investor capital to grow faster, like we talked about, spend more, grow faster, and what the trade-offs are there, or procure an investor capital, or equity or debt, trade-offs, timing, and how to do that, and then be ready for the actual process, the transaction. Those are things we love to be involved in. I think we do a really good job. And then being able to hit the ground running and have everyone comfortable post-transaction. So that's our range of customer. Why I don't think the category rewards taking everyone. I think that there are certainly similarities, and in theory we could expand in terms of who we cover. But B2B tech companies that are scaling is a pretty big market. And I think being really on top of all the KPIs, benchmarks, really the benchmarks and investment activity in that space, as opposed to thinking about that and B2C, or that and hardware type startups, helps us. It helps us deliver top quality service. It helps us bring insights. It doesn't distract us. It doesn't drag us around. There's certainly groups that do what we do in terms of finance, and they'll take anyone and they're like, oh, this is my guy, he's great at hardware. This is my guy, he's great at SaaS. Well, that hardware guy leaves and he's got 3 clients. I don't know how you're going to service them. And that type of stuff makes me really uncomfortable. But because B2B is what we do, the market's that big, and it's what we know as a group. You get more expertise, you get more redundancy, and the firm is stronger and able to serve and less dependent on anybody. So I like our approach. Also, if you have one hardware guy and he soaks up the hardware customers because you got good sales, but he's actually just okay, you're just okay. But like if everyone's doing one thing and they're all good at it and getting better and focused, the bar for knowing the space, navigating the space is much higher. So I'm much happier with all of that, as opposed to the risk and chaos of being overly diversified and spread out.
Makes sense. Hey, I was gonna say, so you guys built a custom GPT that pre-analyzes someone before a call and tells you whether they're a fit or not? Like, can you walk me through it? I guess it seems like a good
Yeah,
habit.
so we didn't build. This is cool. We didn't really build we had a GPT, by the way, but we don't use that for prospecting and scoring and sourcing. We actually use a different agent protocol. So we have a series of agents that work together, and we use this really cool system created by a YC-backed company called Pentagon to help work with the agents. So we have a bunch of agents, and we have ICP scoring criteria, and we're able to send them to go look through various data sources and come up with potential customers, and then score them based on the ICP criteria, and surface them. So like everyone says, like, hey, the CRM of the future is going to find you customers, not just like log data. So we're actually doing that. Our CRM is constantly being populated with new targets that the agents are finding based on the criteria we have.
Got it. Interesting. I guess yeah, I was gonna just to maybe land the plane here with you a little bit, but what does Centripetal look like in 3 years if you guys get it right? And then yeah, one follow up, but yeah, I guess first question.
3 years if we get it right. I'd say in 3 years we're about 20 odd clients, and they're all being serviced very, very well. There's a lot of recurring work that is highly automated, which I think we've already made a lot of progress on. But AI is just infused in everything we do in the back end. The front end is still about people and judgment and relationship, but people have access to as much support as possible, both internally and technologically with that. So customers are happy. Customers are growing. We're working with folks 15, 20 million ARR, 25 even. So we're able to extend the lifetime value by extending the life of the engagement because we're able to do so much so quickly with technology. And I would say if in 3 years from now, we would also be doing, we'd be partnered with several funds to do Q of E and or cash proof type diligence services as well. So you'd see us potentially before a deal from the fund side. And I think that would be another important work stream for us. And then 3 years out gives me enough time. I could say this too. I would say that in 3 years, all goes well. We have a small fund on top of what we're doing, and we're looking for opportunities to invest in our clients in various ways, whether buying secondaries or putting additional primary on the balance sheet. It's not a big fund. We want to be very complementary of the larger funds that are out there, but it's a bit more of a special situations fund, and it's allowing us to participate more directly in our clients' upside, supporting that and bringing capital where needed.
Interesting. Hey, last one, man. What's the one question about startup finance that nobody's asking you right now? And I guess what's your answer to it?
I mean, people are asking a lot. They're asking about AI. They're asking about SaaS. They're asking about everyone's always asking about valuations. What's the question no one's asking? I don't think nobody's asking this, but I think that a lot of founders are asking, like, what's this company worth at this stage or size? Probably not enough folks are asking about like, okay, so what is my retention? And what does that look like? And how do we break that down? What are the right benchmarks for levels of spend in the business around gross margin, sales and marketing, R&D, G&A, things we get to naturally. Everyone looks at growth and they can measure growth, and they're good at that. I think most folks don't drill down further and try and get a sense of where am I overspending, where am I underspending,
Right.
and then they can think about why. There could be a darn good reason, but like they're not looking at that. And there's certainly growth is a critical metric. It's 1A for valuation, but retention's 1B, and probably not enough folks are really paying attention to how to calculate retention, how to potentially massage it, not in a bad way, but to like take the raw data they have and make sure it makes sense in the calculation so it reflects the business, which is not so easy. And then how to own that and think about that. I think you asked about retention, like, yeah, no one's churned. I mean, like, yeah, but a bunch of people downsold, a bunch of pilots didn't go live. So I think that a bunch of contracts that were sat, didn't go live. And I think really what's our retention, what's that look like? How do I make sure the data represents that? It's a huge component for investors. Yes, you could argue the retention benchmark's gone down. I've seen some data around that. But it's still really important, man. If you're not retaining clients, then what are you doing trying to acquire them? So it's just critical for a healthy business. And so, yeah, sales efficiency, percent spend by department to understand how you're doing versus benchmark and why. And then really number one would be retention. And people don't get that deep. And once you got a couple million ARR, you've been around for a couple of years, even before that, you should know, but then you should definitely know.
Yeah. That makes a lot of sense. And I know I keep saying last one, but I promise this will be the last one. So what's the one conversation that you guys have to have with like a founder that nobody else in their life is willing to have?
Well, I don't know about nobody else in their life. I don't know about that. But I would say some of the conversations we have with founders that if you growing the clock back 8 years, when I started to do this work that I think surprise every single founder I've worked with, every single one, their personal finances have come up in the conversation at some point. At some point, there's a conversation about, oh, well, I might want to sell. Well, why? Well, this certain financial goal. Oh, I might want to sell secondary. Oh, can I give myself a raise? Oh, should I go take my salary to zero, but how could I afford this? We've seen all those things like a lot. There's not one founder sitting there saying, oh, that's me. It's like there's probably like 3 or 4 for each of these. And for, hey, here's my personal finances. Here's how I'm thinking about that. That's all of them. So I think that's something that comes up just a ton in our work. If you're embedded, if they really trust you, if you understand the business, the timeline, like this is a huge asset for someone.
Right.
So inevitably it connects to a broader personal picture. A lot of founders have families or thinking about having a family at some point, right? And so how does this connect with that? Like that is a huge component of the relationship that comes out over time.
Cool, Charles. Well, where do people learn more about Citadel? I'm sorry, Centripetal. When you, Charles, are you blogging or posting somewhere? Like, where do you share these thoughts?
Yeah, good question. So I'm very active on LinkedIn. I like to post my thoughts there. So I think that's a good place to see what I'm thinking about, what's going on with the organization. Obviously, there's stuff we don't post about till much later sometimes, like versus when it's happening. So it's a lagging indicator for us. But in terms of where we're posting about metrics and things like that, that stuff's all very current. Maybe company news is behind. But I would say if you're going to reach out via email. My LinkedIn inbox is flooded. It's kind of a cesspool. I wish it was easier to manage and whatever, but that's just what it is. So you can email me. It's my first name, Charles, at Centripetal Advisors. And you can find the spelling of Centripetal on the website. But email is the best way to reach me still. Unfortunately, LinkedIn's tough, and I'm not as active on X. But at some point, hopefully that'll change. But LinkedIn's been good. I like writing my long articles and get my thoughts out there. And everyone's pretty responsive, so I'm happy.
Awesome, Charles. I'm going to bring this one to an end. Thank you. Just hang back for 1 minute, Charles. I see we have a bunch of people listening live, and I guess to everyone else in the future. Until next time, cheers.